there are many different paths up the mountain. You can do momentum. You can buy very cheap stocks. You can buy extraordinarily high-quality companies and hold them for decades. There are all of these different paths up the mountain. But one thing that struck me about the greatest investors who've sustained their success over decades is how similar they are in looking for value. They're trying to value businesses and buy them for much less than they're worth, which is an observation that came from a great investor named Joel Greenblatt, who famously made 40% a year for 20 years, at which rate I think you turn $1 million into $836 million. And when I went to interview him in the Hamptons, we're sitting by his beautiful house overlooking the Atlantic Ocean. And I said to him, Joel, what's the secret of investing? And he says, William, it's just so simple. He said, you value a business and buy it for much less than it's worth. And I found that very consistently with a lot of the greatest investors, this emphasis on understanding this most essential rule of the game, which is you need to value businesses and buy them for less than they're worth. And so someone like Howard Marks, again, another of the greatest investors who oversees something like $160 billion at Oak Tree Capital Management, said to me, what I want to figure out is how much optimism is priced into an asset. And if there's too much optimism, if it's overvalued, I don't want to buy it, because he said the most important thing is, am I buying it cheap? So even though there are all of these different paths up the mountain, I think you really need to focus on valuation. You want to be getting more than you're paying for. And that just seems like one of the most essential rules of the game. And it brings up really important questions, because one thing I realized is, well, I'm not very good at valuing businesses. So maybe actually I shouldn't be buying individual stocks. And there's a wonderful line from Joel Greenblatt where he said that if you buy individual stocks without really knowing what you're doing, he said it's like running through a dynamite factory with a lit match. And he said, you may still survive, but you're an idiot anyway. And I took that as a great piece of advice, that either I have to really know what I'm doing, know how to value a business, or I should probably be outsourcing my decisions to somebody who knows better than me, or I should be buying index funds.
Right, fair point. That's a very fair point, and it's your humility that you are actually candidly admitting your own personal style in a way. But it's interesting you brought up Howard Marks, because just today, this morning, I was reading Howard Marks' latest memo, and he's written about something which he's been writing for 40 years, and this time he's picked up about a subject which he hasn't really thought about writing in his memo ever before, and that is the art of selling. Anything which comes to your mind when you have spoken to dozens of these successful investors on their idea of taking profits off the table, on their idea of booking profits, or they just like to keep their profits running for a long time? How do they negotiate in their minds when to book profit, when not to, or as Howard put it in his memo, letting the losers compound sometimes? Anything which comes to your mind on profit taking and selling their positions when you spoke to the investor fraternity for such a long time?
I think it's an eternal problem and challenge for any investor. It's probably easier to figure out when to buy. You can see that something is cheap, you can see it's undervalued, and so it's not that difficult perhaps to time the purchase. But knowing when to sell is excruciatingly difficult. And Joel Greenblatt, who we mentioned a minute ago, said to me that he always sold too early. He said if you're obsessed with buying things cheap, you frequently sell too early. So for example, he bought Moody's when it was incredibly cheap many years ago and it made a lot of money and then sold it, whereas Warren Buffett just kept it indefinitely and made billions of dollars. And Greenblatt said that's been a problem for him throughout his career. This determination to buy things cheap meant that it was very hard to sell, to sell at the right time, because he just couldn't bear to hold something that was very expensive. And then I think of someone like Nick Sleep, who I write about at great length in my book, who bought Costco and has held it for, I think, 18, 19 years so far, bought Amazon and has held it for 16, 17 years. And I was talking to him recently, and he said to me, he found a piece of paper from after the first time I think he had met with Jeff Bezos from Amazon. He said the piece of paper said, never sell this stock. And here he is 17, 18 years later, never sold it, has no intention of selling it. So I do think there's a beauty to that approach where you can find something that you love that's going to continue to compound and hold it forever. But in the world we live in, where entropy is such a strong force, where things change the whole time, things are disrupted by technology, things are disrupted by pandemics, by economic change, by inflation, it's very hard actually to find anything that you can say, I really want to own this for 10, 20 years. I think that's an extraordinarily difficult challenge, and it's not something many of us can do, I think.
Right. William, there's another saying in the market that every now and then a generation of scores of new investors with money flock to the market where there are people with experience sitting, and then the situation changes. People with experience get the money, and people with money who have just flocked to the market get experience. Some sort of a similar phenomena seem to be playing out across the globe right now. Hordes of new investors, new generation investors are flocking to the market. We call it Robinhood over there. Back home in India too, millions of them are joining from tier 2, tier 3 towns. How do you see this? Is this a big global generation shift which is happening? Some of them perhaps may get hurt. Has it happened all the time? You've seen the market evolve over so many years. How do you see this phenomena?
Well, I started as a financial writer in the late 1990s, and it was a time when there was tremendous euphoria. And I remember at the time people would pay any amount of money to get into a dot-com stock that was going public. And you would see these terrible companies with no earnings, sometimes with barely any revenues, would go public, and they would go up 600% in a day. And it drew in a lot of innocent, naive investors who thought, God, this is fantastic. It's a one-way bet. Whatever you do, it's just going to go up and you can make money instantly. And I think you see a little bit of that mentality at the moment when you see stocks like Tesla just shooting up like crazy, or you see cryptocurrencies shooting up hundreds of percent. I think it's very easy for people to start thinking, wow, this is an easy game. And I've tried to focus in my writing on great investors who've survived the test of time, who've endured over decades. And I think one of the consistent traits of these great investors is that they say, well, let me be a bit more humble. Let me be a bit more cautious. Let me be aware that the future may not resemble the present period. And things can change. Things can get ugly very quickly. And so I think if you're setting yourself up to succeed as an investor for the long term, you want to be extremely cautious. Yes, you want to participate in the forward march of mankind, in the fact that productivity increases and populations grow, and companies become incredibly innovative. You want to take advantage of that, but you also want to be extremely wary of irrational exuberance, of people behaving in the sense that, of people behaving in the expectation that things will always be good, that they'll always surge. And so I think you want to ask yourself, always, where am I fragile? Where am I exposed? Am I overreaching? Am I betting money that I can't afford to lose? Am I betting on things that I don't really understand? And just to focus on what would happen to me if the pendulum swung in the other direction. Would I be in real trouble? Would I be overexposed? So it sounds like a bit of a downer, but I think this is a key to survival. It's just this awareness that this isn't a one direction market, and that you can't throw caution to the wind. Howard Marks said to me that you always want to ask yourself, am I overreaching, and am I pushing the limits? I think that's a very good question to ask yourself. If you have too much money in one stock, one fund, one asset class, one country, you're probably holding a loaded revolver, and you just want to say to yourself, let me diversify a little bit more. Let me be aware of what would happen to me if the unthinkable happens.
William, we've been observing the way India and its place in the global order is also improving, be it market capitalization representation, be it the kind of flows, both FDI, FIs, India is recipient of. The way Indian fund managers globally are becoming more and more popular and bigger. Many of them are launching their new funds in India. How do you really see when you interact with top global investors across the world? I mean, just imagine Howard Marks has made a couple of visits to India in the last couple of years. So how is India's position is improving, and how do you see that gradual and slow metamorphosis of our country and investors over here in global investing order?
I interviewed Ray Dalio a couple of weeks ago, and Dalio, as your viewers will know, is one of the most successful hedge fund managers of all time. Here's a guy who oversees about $150 billion, and his personal net worth, I think, is about $20 billion. And Dalio has come out with a new book about positioning yourself for the changing world order. And he writes in a very interesting way in this book about the position both of China and India. And it's very clear that as an investor, you need to position yourself to understand the increasing importance both of China and India. And he, from my perspective, paints a very worrying picture about the US and many of these old world powers. I come from England, and England he describes as being on this kind of slow, I guess sort of a descent, a loss of power, a loss of importance. It's got a great lifestyle, but it's a country kind of moving sideways or in slow decline. But he also paints a similar picture of the US as being in a somewhat treacherous position because of political divisions, overspending, too much debt, too much printing of money, that it's becoming financially vulnerable. And by contrast, he regards both China and India as rising powers. China very dramatically rising, and probably going to take over from the US as the world's great power. But India also with tremendous advantages. And so I think for any investor, there's a temptation to be very parochial, to look at your own market and think, well, this is everything, this is the whole game. And I think for whether you're in India or whether you're in the US, you want to position yourself to be very international. And this is something that I know that Lauren Templeton is part of this conference, and she comes from this extraordinary lineage. Her uncle, Sir John Templeton, was probably the greatest global stock picker of the 20th century. And he always said this, that he just said it made no sense to be parochial, just to focus on your own market. He said there are so many great companies in other countries. And he was in many ways the first person to show the way to do that. And I think he presents us with a great role model, really, to be more international and to look at great Indian businesses, great Chinese businesses, but also to be aware that each of these cultures is very different, and you need actually to be quite sophisticated to study these different cultures. I wrote about someone called Laura Geritz, who's a great international investor. She was talking to me, for example, about just how different it is to invest in Japan, because she speaks fluent Japanese, but she's based in Utah here in the US. And she said they just have a totally different attitude towards shareholders, for example. They care more about their partners, they care more about their employees. And it's just a different culture. So yes, I think you want to be very international as an investor, but you also want to be humble enough to understand that each country has a very different culture, a very different way of doing business, and that you need to educate yourself about that culture.
Right. Very good point. In fact, yes, we are speaking with her as well. And I remember in your book you mentioned about some of those rare interactions you've had with Sir John Templeton as well. Moving on, we would like to understand from you, William, today, for our younger investor audience, as you just said, thousands of new investors are joining the market. Perhaps India is in a moment right now from 3 to 4% of its total investable population used to invest historically. That number is expanding with each passing month. Probably that's what bull markets do. They attract newbies. But what would your message be to this younger investor community? How to skill themselves, how to equip themselves to become better investors, and the importance they should pay on pure skills, hard skills, and temperament? Because you worked on that as well a lot.
I think it's very clear from my interviews with the greatest investors that they've studied very intensively. They take this game seriously. And this is something that struck me from Monish Pabrai, who we mentioned before, that he said, I'm playing this game against all these people who don't even know the rules of the game. He said, what chance do they possibly have? And so he decided very early on that he was going to learn the rules of the game. And so he went about learning the rules of the game by studying people like Warren Buffett and Charlie Munger. And one of the things that you learn from Charlie Munger, who's this 98-year-old polymathic genius who has been Warren Buffett's partner for the last 50 years. This is the most successful investing partnership in the history of the world. So you want to study these guys. And one of the things that you learn from Charlie Munger that I write about in my book is simply the importance of not being stupid. That what you really want to focus on is not, how do I get to be the greatest investor? What you want to focus on, as Munger would say, is let me not be a fool. Let me first figure out what doesn't work. Because as Munger says, it's actually easier to identify what doesn't work than what does work. And so in my chapter about Munger, he talks about all of these different ways in which people mess up, in which people sabotage themselves as investors. And I think one of the first things that I would do as a young investor would be to study Munger and say, okay, so what doesn't work? And so what Munger does is he says, let me invert, let me focus first on what a terrible investor would do before I try to focus on being a terrific investor. So when you think about the things that terrible investors do,
invert.
They believe that they can predict the future. They believe that they can predict whether the market's going up or down, which if Charlie Munger and Warren Buffett and Howard Marks and Joel Greenblatt can't do, I'm pretty convinced I can't do it either. So I think you want to be humble about that and say, okay, I don't know whether the market's going up or down. I don't know how much it's going up by. So let me at least position myself to survive an uncertain future. I don't want to bet blindly that everything always goes up. You also don't want to trade in and out of the market because you don't want to. You want to benefit from compounding. You want to stay in the market.
Right.
So those are some of the key things.
Right, William, I want you to share some insight with some of these. Right, William, I would urge you to share an insight or two about some really not so popular but very successful, reticent and very hidden kind of an investor. We follow most global investors. All of them are read about here in India. Like example, there was a gentleman called Rick Gurian who was the third partner of Buffett and Munger, and Buffett himself, I've read about it, telling about Rick Gurian that he was in a hurry. Everything else, he was smarter than us perhaps, but he was in a hurry and he started using leverage. Not many people knew about Rick Gurian. Similarly, can you share a thing or two, and what did you learn about some of these not so popular global legendary investors?
Yeah, in a sense, I think the chapter that may almost have had the most impact on readers is a chapter about these two guys, Nick Sleep and Case Zakaria. And Case Zakaria is fascinating. His family fled from Iraq. They were purged from Iraq, and they arrived, I think, in an old Volvo that somebody had given them along the way. They drove to London, and he became a refugee as a young child. And he was a very clever mathematician, and he ended up joining with Nick Sleep. And they decided to set up this very unconventional partnership called Nomad that was, as they described it, almost a metaphysical and spiritual experiment. And they decided that everything would be devoted to quality. They would be buying high quality companies. They would be treating their partners with quality, with total integrity, with fairness. It wasn't really about making as much money as possible. It was about thinking well. And the irony is that they ended up beating the market by something like 800 percentage points over 13 years. And what they did is they just invested in extraordinarily high quality companies that had what they regarded as, they called it scale economies shared. So these were companies like Costco or like Amazon that as they grew bigger, instead of their size becoming a hindrance, they would share their cost savings with their customers. And so they kept driving down costs for their customers, giving more benefits to the customers, better deals, cheaper prices, more efficiency. And so their scale actually became an enormous force for their growth. And this chapter actually had an enormous impact on Monish Pabrai, who said that he's actually changed the way he invests, because he realized that he wants to load his portfolio with these great companies that have this type of longevity. So for me, one of the morals of spending so much time with Nick Sleep and Kay Sakaria was just this simple idea of wanting to focus more on quality, not only in the companies that you invest in, but actually in how you live your life. When you look at the way that people like Charlie Munger and Warren Buffett treat each other, they operate with tremendous integrity. And I think that's actually a great competitive advantage in life, because they draw extraordinary people into their orbit. They attract great partners, great shareholders, great managers. And so that to me became a very powerful lesson, that you want to lead a life that's dedicated to quality in your work, in your relationships, in the way that you invest.
Right, William, it's so educative to chat with you. We can go on for hours, but we have to wind up the show. But I would like to take a couple of recommendations from you for our viewers, book recommendations, writers you really admire, and you love their books, going through them and rereading them perhaps as well. Some of the books which have a big, profound impact on the way you think. Which ones would that be?
Sure, absolutely. Howard Marks' book, The Most Important Thing, is a beautiful book and very important. I would definitely encourage people to read that. And also, as you mentioned before, his memos, which are available on the Oak Tree website, are extraordinary. And I think this is one of the most striking things, is that the greatest investors actually are often very open about their teachings. And so it's amazing if you can learn from someone like Howard, not only from his books, but actually from his memos, which give you a sense of whether the market is overheated, whether people are taking too much risk. So that's very helpful. I would also read Joel Greenblatt's books. Joel Greenblatt, who I mentioned before, averaging 40% a year over 20 years, wrote a book for his children. He has 5 children, called The Little Book That Beats the Market, that explains investing in such a pure and simple and essential way. And he focuses really on these 2 metrics of how to buy companies that are both cheap and good. And so in a sense, he's distilling the essence of Warren Buffett and Warren Buffett's teacher, Ben Graham, who were both obsessed with this idea of buying cheap, but also trying to buy companies that are good in Buffett's case. So those are 2 very important books. The third book, which is written by a friend of mine, and I helped him write, so I'm totally biased here, is Guy Spears' book, The Education of a Value Investor. And Guy, who I know you've interviewed several times, is extraordinarily open about his mistakes in the book. He talks very candidly about things that he got wrong over the years. And I think that's a critical thing, to admit as investors that we mess up, that as Sir John Templeton said to me once, that he said a third of his investment decisions were, as he put it, the opposite of wisdom, which I thought was a very elegant way of saying, yeah, I can be wrong too. And it's a good reminder that I think we need to be humble. We need to not overreach, and we need constantly to have this learning mindset where we're always aware that there's so much more to learn. You look at Buffett, who Charlie Munger describes as a learning machine, and I think Buffett in his late 80s invested a fortune in Apple, and it turned out to be the most lucrative investment of his career. And this is a guy who had always said he wouldn't invest in technology. And so if Buffett can continue learning into his late 80s, then that makes me have hope. Maybe I can become less ignorant too. So I want to be a continuous learning machine and be reading these books by people like Howard Marks, Joel Greenblatt, also Charlie Munger's book. There's a collection of essays and speeches called Poor Charlie's Almanac that I think is a very important book. It's a big, massive, monumental tome, and it's not an easy thing to get your head around. But I think you want to be hanging out with this dream team of great investors and really trying to internalize their ideas. But it's not just about an intellectual pursuit. It's about actually making these ideas a part of your life. So when you see someone like Charlie Munger saying, just try to be less stupid. You actually want to do it systematically and say to yourself, okay, so am I doing something that is what he would call a standard stupidity? So this isn't just about book learning. It's actually about pounding these very practical habits and traits and principles into your head, so that they guide you in this murky world of ours.
All right, William, we'll let you go on that one. Thanks so much for your time today. Wonderful chatting with you today.
Thank you. It's been a real
Bye-bye.
delight.
Have a great day.
I hope to see you again soon.